Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis, welcoming you to my podcast Money Talk for Tuesday the 19th of September. You can find this podcast on Substack, Apple Podcasts, Google Podcasts and Spotify. Just search for Peter Lewis Money Talk. That's also my page on Facebook and Instagram. And thank you for making this programme one of the most listened to financial podcasts in Hong Kong. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, China Evergrande said Monday that the arrests at its wholly owned subsidiary Evergrande Wealth Management won't affect the company's operations. Shenzhen police detained some staff at the unit on Saturday, suggesting a new investigation that could add to the property giant's woes. Yesterday, Evergrande Property Services, the property management affiliate of China Evergrande Group, said it remains uncertain whether it can meet its debts in the next 12 months after offering guarantees to secure almost $2 billion worth of loans for its parent company. China is facing a sudden surge in FX outflows, according to Goldman Sachs' preferred gauge of FX flows. China's net outflows were $42 billion in August, the fastest pace of outflows since December 2016, and that compares with $26 billion of outflows in July. Foreign investors' net selling of equities through the Stock Connect channel rose materially in August, contributing to the acceleration of outflows. Singapore's non-oil domestic exports plunged by 20.1% year-on-year in August, far worse than forecasts of a 15.8% fall. The latest reading marks the 11th straight month of contraction due to a further fall in both electronic and non-electronic products. And oil advanced for a third day, with Brent pushing towards $95 per barrel following the OPEC Plus supply cuts. Saudi Arabia's energy minister insisted yesterday that the kingdom's decision to extend oil production cuts was not about jacking up prices. Brent crude oil rose 0.5% to $94.43 a barrel after rising 3.6% last week, the third consecutive week of gains and the 10th week out of the last 12. On today's Money Talk, I'm joined by Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, Alicia Garcia Herrero, Chief Economist for Asia Pacific at Natixis, and our US economics correspondent, writer and broadcaster Barry Wood. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com, and you'll also find there my daily newsletter with plenty more business and finance information from around Asia.
Peter Lewis's Money Talk.
On Wall Street Monday, US stocks started the week little changed ahead of key central bank meetings in the US, UK and Japan. The S&P 500 inched higher by 0.1% to 4,454. The Dow advanced just 6 points, that's under 0.1%, to end at 34,624, and the Nasdaq Composite was flat at 13,710. The US dollar index held above 105 on Monday, hovering near its highest level in 6 months ahead of the Fed's policy decision this week. The yen was flat against the dollar at 147.62 Japanese yen. The Bank of Japan is expected to refrain from any policy changes at its meeting this week, with the bank rate at minus 0.1%. The dollar was 0.2% stronger against the Chinese yuan in Shanghai at 7.2915 renminbi, and the People's Bank of China is expected to release its loan prime rate decision on Friday. Hong Kong shares led losses in Asia, hit by further woes for the property sector. The Hang Seng Index slid 252 points, or 1.4%, to 17,931, approaching its lowest level in nearly a month after gains in the prior two sessions. The Tech Index tumbled 2.2%. Mainland Chinese markets rose slightly, with the Shanghai Composite up 0.3% at 3,126. Shares of China Evergrande plunged as much as 25% at one stage in Hong Kong before recovering to end the day 1.6% lower as police detained some staff at its wealth management unit, and shares of Country Garden fell almost 2% ahead of a vote on extending payment of a local bond by 3 years. And looks like the Hang Seng is going to open flat this morning at around 17,930. And you can get more details on those latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk.
Peter Lewis's Money Talk.
Let's get straight to it and welcome our guests this morning. We have with us Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia. Morning, Mark.
Good morning, Peter.
And also with us, Alicia Garcia Herrero, who is Chief Economist for Asia Pacific at Natixis. Morning, Alicia.
Good morning.
And over in Washington, D.C., as always, on a Tuesday morning, we find our US economics correspondent, writer and broadcaster, Barry Wood. Morning, Barry.
Good morning, Peter.
And it's in the US we're going to start because the financial landscape is going to be heavily influenced by the Fed's interest rate decision, which will come in the early hours of Thursday morning Hong Kong time. The US Central Bank widely expected to keep rates at 5.5%. The Bank of England meets on Thursday. And then in Asia this week, central banks in China, Japan, Thailand, Indonesia and the Philippines, as well as Hong Kong's de facto central bank, will be deliberating on their monetary policy direction. Barry, no point trying to predict what the Fed's going to do. I think we know what it's going to do anyway, don't we? But the interesting thing I think about this meeting is we get the dot plots back again, don't we? Where Fed members get a chance to forecast what's going to happen next year. And then what's going to be particularly interesting, I think, is when do they think we're likely to start seeing rate cuts? That's the key issue for markets, I think, right now, isn't it?
Yes, I think you're right, Peter. You know markets, and that's what people will be looking at on Wednesday, U.S. time. I think that there's not going to be any interest rate cut in 2023. We've only got 3.5 more months. I don't see an early cut in 24, but it's the real change is that no one is now expecting recession. They're not even expecting slowdown. So these 11 rises over 16 months, taking Fed funds, the short-term rate of the Fed, to 5.5%, I think that's over. I mean, that's done. But it has not killed the economy. So I don't think there'll be any surprises. But as you say, people will be looking to see what the forecasts are.
Alicia, the Fed's in a bit of a happy position at the moment, isn't it? Because inflation is probably lower than where it was predicting when it came out with its last set of dot plots, and the economy is doing better than what it predicted when it made its last set of predictions. So not a bad position for the Fed to be in. Do you think they're now on top of it and inflation has been conquered?
Well, I would say that, yes, it has been conquered, but it doesn't really mean that it will be a linear reduction. And we could have some surprises for the very simple reason that the economy is stronger than anybody had thought. So, you could imagine that you could still see some second-round effects, some wage increases here and there that would make the stickiness of core inflation more sticky, if I may say so. But I agree with you, and I would add one more point, that the Fed has been very successful, very successful. In fact, it's just amazing how successful it has been. If you look at the dollar also, we could have imagined a collapse in the dollar, people expecting cuts. I fully agree that it won't be before 2024 and perhaps not even at the very beginning, but that's not what people had in mind. So they avoided a collapse in the dollar. They avoided a banking crisis. They avoided, they controlled inflation, and they avoided a recession. How they did that, I don't know, but it's quite impressive.
Was that down to luck, or because when you think about it, they started pretty late on the rate hiking trail, didn't they? Originally, they thought this was all going to be transitory, and were clearly wrong. So, was there luck in this, or have they just judged it completely perfectly?
So basically, I think they were late, but the ECB was even later. So it's hard to argue that the Fed was totally wrong. Everybody was wrong. Number one. Number two, I think they did the SVB, the Silicon Valley Bank, very well. They avoided contagion. Yes, they created a little bit of moral hazard here and there, saying deposits were guaranteed, but they managed. And how they did it, I think they didn't listen to the markets, sorry to say, because the markets were asking for cuts all the time, and it never came. And I think that resilience by the Fed was extremely important.
Mark, you've just updated your IMA third quarter outlook. Where does and you've set out a number of risks that could come to impact the global economic outlook, and then more specifically here in Asia. Where does inflation and rising interest rates fit into the list of worries among your members?
Well, it fits in very strongly in places like India and elsewhere, where it could have a a much larger impact in 2024 even than it is now. So it's still a worry. But I agree with both Alicia and Barry. Certainly the expectations have gone down. The University of Michigan survey seems to indicate that as well. Politically, it doesn't do either Chairman Powell or the Biden administration much good for some reason or another, but they have managed it well. So our forecast, and we don't know either, is that the rates won't start to go down till at least the second quarter of next year and maybe a bit later. So, but still everybody's watching, and that's the key number. But worried about next year, less worried about China, interestingly, than about some of the other economies in the region.
Mm.
Mark, I think that Alicia's got it absolutely correct. I mean, this has been a very successful Federal Reserve policy escalation of interest rates, but yet it didn't do the damage that was expected. When you look at, I think she's also right when you say, Alicia, that inflation is going to be sticky. It is a little over 3 now, maybe 3.5. It's going to be hard to get it to 2. That's maybe part of the reason a lot of people think give up on 2. But we're still creating jobs. We're growing at 2.5%. So it's looking really good here, and we'll see what happens.
Is one of the reasons that that things are looking better economically is because although mortgage rates have surged, they're above 5% now, aren't they? Most people aren't paying that. Most people are paying way below 3% even because they locked in their mortgages at these really low rates. How much has that been a big factor in keeping the economy on track?
Well, I'll take a shot at that. I think it's been very significant. But I think that we're going to see a slowdown in the housing market. I don't see how that can be avoided. It's already happening in commercial real estate, largely because of the work from home thing, which has really devastated so many properties everywhere in the country, probably lots of places in the world. But interest rates are double that. Savers now, for the first time in 20 years, are being rewarded. We have positive real interest rates. It's extraordinary. So there's been a transformation underway. And yes, you're right, Peter. A lot of people have these long-term mortgage rates, 10-year fixed, 30-year fixed. They're okay. But anybody trying to buy a house now, buy an apartment, we've not yet seen a decline in prices, but I think that's coming. And the price, and when you add it all together in terms of what you have to pay and what you have to pay to service your mortgage, it's a real problem.
Mm. Alicia, tell us about the Bank of Japan, because they're meeting as well, of course, this week. In some ways, this is more interesting than the Fed, because Governor Ueda keeps teasing us every now and then that he's going to move away at some point soon from these ultra-low interest rates, but then tells us that we misunderstood his comments and things go back to where they were. But surely, at some point soon, Japan can't keep negative interest rates.
Well, absolutely. And I think there's 2 reasons for the BOJ to need to recognize that they can't be the one and only major central bank in the world with negative rates. First, the yen is very obvious. Secondly, the fact that, like their own lifers, no matter how large the home bias is in Japan, I think their lifers are going to start reinvesting. I say reinvesting because last year actually they repatriated a lot of funds, but I think at some point, unless something happens on the shortest end of the curve, at least for money market funds, they're going to just put the money away, and that's going to weaken the yen even further. So yes, they have to do something, but quite frankly, I don't think it will be this week, because they need to prepare the market. Otherwise, it could be quite wild, I would say, in the JGB market and probably the stock market in Japan.
I mean, this could have quite a significant impact, couldn't it, when the Bank of Japan finally decides it's going to exit this ultra-loose monetary policy and rates are going to start moving up. It's going to be something that we haven't seen for a very long time. And when we just saw that tweak to the yield control curve last year, that had a big impact on the markets. Do you think the markets are ready for this?
Well, they already saw the tweak on the yield curve control, so we're already at 1%. I think they will keep it while they move out of negative rates. So basically, they will engineer a less steep curve for the moment, and then possibly start lifting the yield curve control limit. But I don't think it will go so far, maybe some overshooting, just because at the end of the day, Japan's potential growth is low and interest rate should be low. It's not the US. So, I think it'll hover around 1.5 when everything is lifted, maybe 0.25, maybe 0.50, maybe 1.5. So, still steep, but slightly higher. I hope that's where it will stop. For the sake of the Japanese MOF, which needs to pay the debt, interest payments on the debt, I don't think interest rates can go very far in Japan because of the debt service being extremely large for the government. So that's in a way natural limit to interest rates.
Okay. And Barry, do you want to? Sorry, Mark.
Just one quick point. The BOD, I think, Ueda understands the situation. He just is limited in what he can do for internal reasons. The Japanese making a decision in Japan, policy decision, is still very difficult for some of the reasons that Alicia just cited with the MOF and others looking at this. So I think they'll move in that direction, but it will be slower than expected. Saying that, there are a lot of companies, including a lot of our members and the reports from the U.S. Embassy, they're having to close the doors because there's so much demand for companies looking at Japan, reinvesting, putting new businesses, expanding old businesses and so on, which is something we haven't seen for many years. So we'll see how long that continues as well.
It seems the business environment in Japan has completely turned around in about a year or so, hasn't it? It's been quite a dramatic change.
Yeah, and it is. And, there is some confidence, although the interest rate situation and the failure to raise them, to try to keep them even below zero, is an issue, and the weak yen, of course, which can be advantageous for some, but for this long a period and for no end in sight, at least in the short term, that is a little worrying, I think, for everyone.
Barry, do you want to have a crack at the Bank of England? They're the other major central bank meeting this week. Compared to the other two, they're in a bit of a hole, aren't they?
Oh, gosh. Their inflation's too high. They've got to come down on inflation. So I suppose that means there's going to be another hike. But that doesn't do anything to help the economy. It hurts the economy. So it's a tough spot. I'd love to be a fly on the wall at the BOE meeting.
I mean, this is stagflation, really, isn't it, that you're looking at in the UK?
Yeah, I think so. Look, there are too many uncertainties. And I know Stuart Allcroft is there. He'll have a story to tell when he gets back. It's extraordinary. The Southeast is doing well. And yet, all of the uncertainties that came from Brexit in terms of being able to export into Europe, that's not resolved. And as a result, there's no real dynamism in the economy, only in services. And that's a problem. So, yeah, it's hard to be optimistic about England.
Okay, well, let's switch our attentions to China. Alicia, we had quite a lot of economic data out on Friday, the activity data. I suppose the standouts was the improvement in retail sales and industrial production, but it did look like that anything related to property still wasn't doing so well. But do you get the impression that overall maybe there are signs of things improving?
Well, I would say that on property, it's quite simple. You cannot fall from the floor. It's very, very hard. If you have 400,000 transactions a month, which is the minimum ever in China, you're not going to see a further reduction. All the less so if you think about the measures taken by different local governments to actually support purchases. So I would say that it's only natural that we don't see a further deterioration. But we still have very negative price increases, so basically decreases in third-tier cities. So I think that we're going to see an increasingly dual market, with first-tier cities improving somewhat, but not the rest. And that's not going to help for common prosperity if you think about it. Yeah, it's like you're going to have increasing income disparity in China. For the rest of the economy, very briefly, I think what the data said is a little bit the same story. You cannot fall from the floor. It is better, but it still, retail sales are growing half of what they were growing before COVID. So the recovery is still quite slow, I would say, if you go back to pre-COVID world.
We've got to forget the pre-COVID world, haven't we? We're not going to see retail sales growth of sort of 8% or the likes that we were seeing back in those days.
That's right. Yeah, absolutely. I think we need to forget it, but we can't deny that we're not in a pre-COVID world. So what I would say, yes, there is slight recovery. That's great news, but we're not back to where we were. Absolutely not.
Mark, what are your members saying about China?
Well, that's exactly that, in the sense that the expectations, of course, were much higher for the Chinese economy this year. And although we're forecasting maybe a little better 2024 for China, but still the property overhang. But it's those expectations that are important, because many of their business, they expect it to grow, and consumer sentiment is a good part of it. And although it's come back in some areas, it's not very strong, not nearly what they hoped for. And, although they didn't expect pre-COVID levels, they expected better than they thought. Of course, the U.S. is an upside surprise, but China's not. And that's key to their businesses in not only in China, but in the rest of Asia. So even as they look for alternatives, elsewhere in Asia, it just doesn't make up for China in either production or sales.
It does seem we're seeing, not just in China, but certainly in China, but also elsewhere in the world as well, in the US, the EU, in India and elsewhere, much more nationalistic industrial policies designed on sort of ring-fencing certain industries, protecting certain industries. Is that, how worrying a trend is that?
Well, I think it's a worrying trend indeed. And I think that what the Americans want to call friend shoring, that might have something to do with what Mark observes about Japan. Because people look at Japan and say, oh, they're a military ally, and they have now a very favorable exchange rate to put money in there. It's, to Japan, to other parts of Asia. It is, I think, a somewhat dangerous path. But it's going to accelerate, but it goes slowly. It's not decoupling. So maybe de-risk is a good term after all.
Alicia, if we're seeing this slowdown in China, it's obviously very noticeable, been very noticeable this year. What sort of impact is it having on the rest of Asia? Because so many of our economies around here, particularly in Southeast Asia, but not just there, are linked to China. So are you starting to see the impacts of that?
Well, in some cases, say Singapore, we just got export data, non-commodity export data is just terrible, minus 20%. Singapore is suffering. Also, I would say financially, because we have much stricter capital controls from China. Yes, there are still outflows, but they're mostly portfolio outflows, Stock Connect, Bond Connect. I think for outright capital flight, it's getting much harder. So Singapore is suffering. Overall, though, and I think this is the good news, if you look at Southeast Asia more generally, let alone India, I think the impact is more limited than we would have imagined, because there is a lot of domestic demand, supporting the economy. If you look at the Philippines, India, these countries, Indonesia, they're doing quite well. So, I would say, yes, the impact is there, but it is less than we would have imagined. Yeah, that's it.
And I suppose the countries that are suffering the most, the export-orientated countries. Yeah. You mentioned Singapore, but also South Korea, Taiwan as well.
Indeed. South Korea even earlier in a way, because of the semiconductor cycle being so negative in terms of everybody using the stocks they had accumulated during COVID. So South Korea is suffering indeed.
Yeah, I don't want to generalize, but South Korea has been a issue for a lot of our members, in the sense that expectations are stronger than they actually are in some of the areas that Alicia just cited. But parts of Southeast Asia, and Indonesia is a good example, which is always problematic, but it's made some moves, and it seems the economy seems to be more attractive, and the investment environment, still there are issues with foreign companies in Indonesia, but it's become it's become more appealing, as mentioned, as have the Philippines and a few other places we hadn't thought about as much in the last few years. We'll see if that's sustained.
And where does India fit in? Is India immune to what's going on, the slowdown on the mainland?
I think India is the by far more. I mean, it's clearly the case where you see actually, in a way, a positive impact because you have a lot of FDI coming to India out of China, or as a response to China's woes and also the need for reshuffling value chains. However, India has its own problems, two in particular. One is inflation, food inflation, and a central bank that is reluctant to hike in the midst of a pre-election kind of environment. And secondly, a growing current account deficit again. So, it's not about China, it's about India itself. It's not yet dramatic, but, we need to watch. It can get nasty before the elections.
Let me add to that. Export earnings is also an issue, or we see it at least. Resources, goods, tourism, that sort of thing, especially going forward. But inflation, I think, is the big one.
Let's get your thoughts on the Triple R cuts and some of the stimulus measures that we've seen from the PBOC.
Yeah.
All very piecemeal, isn't it? But nevertheless, is it having an impact?
So two things happening. Yes, more liquidity are cuts. We have had a couple of rate cuts, still not very large in size, but it does show that they're trying to help. PBOC is clearly trying to help. Constrained by the exchange rate, though, because, the RMB is so weak, they just can't go all the way to zero interest rates. It would be extremely dangerous for China. But what is also happening, and I think people aren't as focused on that, is that local governments are issuing debt like crazy. They are basically exhausting the quota, a renewed quota, by the way, that was granted to them. So I think on the fiscal side, there is some movement, maybe, as you said, below the radar, but it is happening. Local governments are getting funding in China at the current juncture.
What about fiscal policy, though? We need some supportive fiscal policy, don't we, to go with all this monetary sort of stimulus, which President Xi Jinping seems reluctant to do. He calls it welfareism, doesn't he, if he hands out money to consumers?
So this is the irony. He's quoting welfareism, and I guess he's not ready to introduce any welfare state in China. We hear him, and it's clear. But local governments are being allowed to fund new projects. So fiscal policy is laxer than he seems to claim. In fact, I don't know whether he's claiming that, but the point is that the fiscal consolidated fiscal deficit, if we had those numbers, but we have something called augmented fiscal deficit, which is not fully consolidated. That's the best we can get in China. Is around 12% of GDP, so it's not bad. It's really not bad, and it's not getting any better in 2023, notwithstanding higher growth than 2022. Meaning, fiscal policy is lax in China.
Mark, what would your members like to see done in terms of policy initiatives to try and speed up the recovery?
Well, I think just serious policy initiatives instead of the piecemeal. And I know, and I understand the piecemeal is done for reasons worried about the implications of of going too far in various areas. But this hasn't made many of them who think about this any more comfortable. Basically, as was just described.
Barry, let's switch to the US. The thing I'm interested in is this UAW workers' strike at the three big Detroit auto workers' factories. This seems to be raising some real alarm bells about the impact that this could have on the US economy. Can you give us a sense of just how important this is, what's going on in Detroit at the moment?
Right, my home state. Look, I think it is a serious matter. However, I think the danger for the union is overplaying its hand. Asking for 40% increase, and let's say they would settle for 30% over 4 years. That's still a very significant wage gain, and this is the most successful and highest paid of the trade unions. So far, there's only about 13,000 workers affected. But if this strike goes on, then there'll be more layoffs. There have already been some from the two big companies, and it could become throughout to all 200,000 UAW members. This is good news for Tesla, for Hyundai, for Toyota, because they're non-unionized and they're operating within the United States market producing cars. And the Detroit Three make about, 40 to 45% of all the cars produced in the United States. The impact on the companies will be severe. If the strike goes on for a week or two or three, I think that's really going to have a negative impact on Ford and General Motors. Stellantis, I think, is more a European company. But this is heavy duty, and it's very difficult and delicate for the Biden administration because they come right out and said that the executives were being paid too much, the CEOs. And I think that's true, by the way. I mean, who needs $25 to $35 million a year, which is what both GM and Ford chairman got during the 2022. So that is the strongest thing that the union has going for it. Public support is not really going to be on the union side. It is among the elite of the journalistic community. But if the strike goes on, people are going to look too much at what these auto workers already make. Certainly, they all make at least $35,000 to $50,000 a year, and they have very generous retirement, very generous health care. What they want is protection against the inevitable layoffs in engine and transmissions, because electric cars and this transformation that's underway in the auto industry means there will be fewer members needed. And secondly, they want to do something about the two-tier wage system that was introduced way back in 2008-9 when the two companies, or at least Chrysler and General Motors, went bankrupt. So this is a work in progress. I have no idea how this is going to turn out.
Yeah, I mean, extremely challenging, just as Barry outlined. I mean, their percentage of union workers is quite small compared to before, but what they want is really a situation before the global financial crisis, especially in pensions and other areas, which is going to be very difficult. And as Barry outlined, for the Biden administration, they're between the classical rock and hard place where they really can't move. He's shown his support, but it's not going to get him much. It might not even get him the UAW endorsement,
there's no way that a UAW would ever endorse a Republican candidate, let alone Donald Trump. But I will add this, and we all remember the Reagan Democrats, but they were not endorsed by the union itself.
Yeah.
Look, this is a serious problem, and my own guess, Peter, would be that if the strike drags on, it'll hurt the two companies and all of their suppliers, but it won't have much impact on the United States economy.
No, I agree. I tend to agree with that. No, I wasn't talking about them endorsing Republicans sitting on their hands, to a greater extent, which would have an effect. And just adds to the turmoil in a atmosphere of a pretty good economy, as we've outlined earlier today.
What about the impact on inflation, though? If they start to receive, well, it certainly doesn't sound like they're going to get 40%, but nevertheless, even if they received half of that, doesn't that start to put pressure back onto inflation?
Yes, it would. But, and again, that really does highlight the importance of whatever agreement is reached. If it is going to be seriously inflationary, but don't forget, if you're talking 20%, the companies are offering 20% plus over 4 years. So, that's 5%, 7% this year. I don't think it's going to have a real problem. But as Alicia said earlier, inflation is sticky at 3.5%. And it's not going to come down if you get a generous auto settlement.
It is noticeable, isn't it, though, that it's not just the auto workers. The number of days lost to strikes is picking up this year, and that's presumably because workers are seeing, they've seen inflation go up, they're seeing their wages being eroded by inflation, and they're now thinking, well, it's now our turn. We want our share.
You're absolutely right, Peter. And you look at these exorbitant, indefensible CEO salaries. I mean, this is outrageous. I mean, you would think that the companies would have thought of this before they went into negotiations with the union. But yeah, I think that this is a serious issue for the companies, for the economy, but I don't think it's going to have a big inflationary effect. It is true that wages have eroded, but you see nothing of what you saw in the late 70s in terms of this escalator, the saying, I need a raise because everyone else has got a raise. It hasn't spread through the economy, and that, up until this point, has not happened. If it does, that's a serious problem.
If people think their wages are being eroded now, they've seen nothing compared to the 1970s. You only have to say the word Volcker, and that will get people's spine tingling.
A side remark on Asia: it's not strikes in our case, but it is pressure on wages because there are fewer people available for companies. In many cases, they're having trouble finding them, bringing in talent, and if they find them, they have to pay them more. And then someone else will pay them even more. Especially, we mentioned India. This is happening in India very quickly. So, that's a worry for companies here.
Even in Japan.
Absolutely. Yes, Mark, you're right. Here in the States, anywhere you go, you see help wanted signs. That is also giving a boost to labor demands for more wages.
They feel they're in better position, which maybe they are, to demand this.
And let me ask you both, while we're on the subject of autos, what do you make of this dispute between the EU and China over electric vehicles, and the EU's investigation into whether the Chinese EV manufacturers are getting subsidies or not, and are flooding the European market with electric cars? Who's right and who's wrong in this? Or are they both right and both wrong? Barry?
Go ahead, Mark. Go ahead. Well, I think the latter, but in many ways, China does. Of course, they subsidize these companies, but at the same time,
so does Europe.
So does Europe. Europe maybe even more so. They subsidize a lot of companies. But I was just at BYD, for example, which is doing very well, and the engineers and the engineering and the designs and everything are extremely impressive. They're very competitive. And, this is an old story. It happened with solar panels. It happened with a lot of other issues. In some cases, the European companies intervened with the EU hierarchy, saying, listen, this isn't helping us by you doing this. We don't want to compete at certain levels. We want to compete at other levels. And I don't know if that's true in automotive, but I think this is a losing proposition for the EU in the end. But we'll see how far forward it goes. But you can understand.
Peter, my response would be, you ain't seen nothing yet.
Yeah.
Because the surge of exports into Europe and the United States from China, which is building a high-quality car at a much lower cost.
And BYD's they've entered the top 10 now.
Yes. And how do you compete with that when you've got, and to come back to what we were just talking about with the Auto Workers Union here in the States, if you're going to get a boost in wages, are you saying that these are the most productive auto workers in the union, in the world? Nonsense. They're not. The Chinese and Japanese and Koreans are. So, this is a real problem for the Americans. And I think that, I think I've said this before, there will be restrictions. There will be limits placed on Chinese electric vehicle sales in both Europe and the United States if this continues.
Yeah, but the Chinese will continue to make, and there'll still be demand. I mean, this is even this issue sort of that Barry raised in terms of the effectiveness of Chinese manufacturing, the reliability. This is the issue with China plus one and two. Yes, companies are diversifying, but at the same time, they're not finding the same atmosphere as in China. India has significant problems in manufacturing, always has had, in terms of the operating environment, taxes and charges, all the rest of it. China is much more reliable. So even with the higher costs, even with the geopolitics, it's hard for a lot of companies to really make a big commitment.
Isn't part of the problem also that the Chinese market is such a cutthroat market, isn't it? They sell cars on just the thinnest of margins, and most of these companies aren't profitable anyway, but there's no way that the Europeans and the Americans can compete with those sort of prices.
Amen.
Yeah, that's right. And I think that competition is being encouraged by the government, as far as I can tell, and especially in the EV area where there are a lot of competitors.
How big an issue is batteries? Because if you're going to buy an electric car, the batteries are the biggest part of that, aren't they? And China manufactures its own batteries and does it very well because it controls a lot of the raw materials you need, whereas most electric car makers, I think, apart from Tesla's the only one that has its own battery plants. This is where they struggle, isn't it, in Europe and the US, apart from Tesla?
Correct. And yeah, as long as we're going to use lithium, then the Chinese have got an advantage. But Musk likes to say there's lots of lithium around. And we may not have lithium batteries in future. We may have we may have hydrogen. We may have any number of things. I think the bottom line, and maybe it's so obvious that it doesn't require saying, but I want to say it. This is a historic transformation. No one expected it to happen this quickly. It's happening everywhere, Asia, Europe, North America. And it does not seem that it's going to be reversed. The consumer is not the one who's calling the shots, dominant shots. It's the industry itself. They're all responding to the call for a green world. And my goodness, it's moving quickly.
Okay, well, on that note, I think we'll wrap it up today. Thank you very much for your thoughts there. You heard our US economics correspondent over in Washington, D.C., Barry Wood, Mark Michelson, who's chairman of the Asia CEO Forum at IMA Asia, and Alicia Garcia Herrero, who's chief economist for Asia Pacific at Natixis. Thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. On tomorrow's programme, I'm joined by Enzio von File, Capital Preservation Specialist at Financial Shield, and Corinne Hearn, Partner and Chief Sustainability Officer at East Capital Group. And we're also going to take a look at Vietnam tomorrow with Ruchir Desai of Asia Frontier Capital. Bye for now.
Money Talk